conference. Yeah, it's really it's I think we're kicking in now.
Yeah.
I think obviously it's really the conference. I mean, September has really turned into the conference season, and then it kind of tails into October. But the the if you look at the travel of a lot of people in our industry in September and October, it's really something, something. So
Oh, it's
despite
brutal. I've traded notes with some of our partners and just the nonstop back to back, really from Labor Day or even, Western Secondary in late August all the way through annual and basically up to Halloween. It's relentless. It's starting to parallel kind of the spring season too.
yeah,
Yeah. Um,
so we may yeah, it's been tough. So no, I did not go to that. I think many places in the South and the South, especially the Southwest, they give, like Las Vegas, they give discounts, if you show up in August or September. So I think that's that's going on a little bit out there.
Gotcha. I was curious too, and I'll throw it out there now that we're live as well, in case any of the audience has feedback. I was very curious to see how the discussion would go at Sigmo between former director Calabria and Dave Stevens as well, and then saw his LinkedIn post that he had to bow out a couple days beforehand, just with the clinical trial he is tapped to participate in. So. Uh, Obviously to audience, wishing Dave Stevens nothing but the best in his battle with cancer. But if anybody was out there and had any feedback from the session, I know it was, I think, WGA Chairman Chris Whalen filled in his place to dual Director Calabria. Be interested to see what the audience's thoughts were of that, or how that went. But on that note, we're already a minute into the show, and if you can't tell, I'm not Melissa Langdale, but I am Tom Gallucci, or Phil and Tom, as I like to deprecatingly call myself. And happy to welcome you into the latest installment of the Rundown. As always, the show eye candy, Rob Chrisman, joining us in Marin County, or is it a different locale in Cali?
Uh, Cali. Let's not call it Cali, Tom. First off, I am in Larkspur, California, just north, about 15 minutes north of the Golden Gate Bridge.
Oh,
Sitting
you're with.
on. Go ahead.
I was gonna say you're with a group of Midwesterners, so we're just trying to be cool with the lingo.
You know, geographic names like that are I find fascinating. The Midwest. Obviously that name sprang up from when the population center was along the East Coast and people moved west to the Midwest, not the far west or the far east. So anyway,
Well,
I
as Bernard
digress.
put in
I'm
the
already, I'm
chat,
already
we're
digressing.
flyover country. So on that note, let me welcome in our guest for today's episode. Just want to spend some time a little bit later on the broadcast talking about special purpose credit programs. We've got a pair of subject matter experts with us here. First off, he's bottom left on my screen, the SVP of Corporate Community Reinvestment Act Officer with Pennsylvania-based First Commonwealth Bank. One of TMC's original lender members dating back to 2015, Evan Zavernik. How you doing, Evan? Been with the bank, what, 8 years now, and background prior to that, supporting Habitat for Humanity. So uh, clever to have you with us.
Yeah, excited to be here, Tom, and looking forward to having a conversation with the gal who needs no introduction, layered over at iEmergent.
That's right. I appreciate the tee up there too. So we got Laird with us, who's no stranger to the rundown. She's the CEO of Emergent. And if you're not familiar, it's a forecasting platform really designed to leverage data and help lenders close the home ownership gap. And her company has really been at the forefront of driving the conversation within our industry around fair housing and hiring of diverse uh, originators and selling into diverse markets and leveraging data as the catalyst and conduit to that growth. So, Laird, welcome back into the rundown.
Thanks, Tom. And I'm only here because Evan asked me to be here.
Oh, you're come on now. We love having you in here, and I love the hair too. I need to grow some back so I can match you in color.
Uh,
Um,
Tom, you just had to mention it.
I did. I did. And I've got to address one thing here. Rob, you weren't with us last week, but apparently I raised some eyebrows on the show with my Schmedium t-shirt that was a little too small for me and it was a little too revealing in the arms. So I'm a little more covered up today.
well, it's
Um,
it's that prison body you have, Tom.
yeah, yeah. Exactly. And I had to give the shirt back to my 7-year-old son. It fits him a little better anyway. So, in sport of the, we talked a little college football last week. So I had to rock the Ohio against the world. If you didn't catch the Ohio State Notre Dame game, spirited back and forth with Lou Holtz and Ryan Day in the lead up to it. And in his post game conference, he railed about how it's always been Ohio against the world. So had to support my guy and certainly welcome feedback in the chat. Who you guys think would win in a throwdown between 86-year-old Lou Holtz, who probably about my weight and height, against the 6'2" 220 Ryan Day? It could go either way. But we should probably get on to what you guys came to see, and that's some conversation that relates to the mortgage industry. So on that note, go ahead, Rob.
I need to interject, Tom, briefly,
Please.
just in case, because there may be a special guest visitor. I had actually sent her photo out to a poll. I was doing a poll before the show began, sending her photo out. So several people wanted the special guest visitor, which we may have. So we may be having an in-depth conversation about credit guidelines or interest rates or something. But I'm just saying somebody may appear. We'll see.
Well,
We'll see. No
just in
promises.
case we don't get a special guest appearance, I at least want to give you a photo view of Rob's travels on his vehicle of choice in the city of Nashville from the TMC conference. So it's one of my personal favorites, and I had it in my background all week. Looking forward to our conversation today.
I'm a big scooter fan. I mean, what can I say? But you can't mix alcohol and scootering.
Well, so that's why they intentionally shut them down in most cities, Nashville included, by 8 p.m. most nights, so that the drunkards can't get on them when they're inebriated and cause some accidents.
There we go. Good.
Well,
Nothing good happens after 8 o'clock anyway at conferences, right?
except the business that gets done in our industry.
That's true. That's true.
Well, a little bit somber note, kind of driving in here. As you guys may have guessed it, there's no real progress happening from our congressional leaders as far as this impending government shutdown or a potential Hail Mary for a CR, they call it, or a continuing resolution that, if it had been addressed, would have kicked the can down the road, as government likes to do, till November 17th. So, Rob, you put it astutely in your Monday commentary. Just some great feedback, including MBA's guide, outlining some contingencies as it relates to government programs and agencies direct with housing, and some of their contingencies or what lenders can expect should this shutdown go through. So if you guys look back, that's a great resource out there. I'm also going to drop in the chat. There was a good M Report article this week earlier talking about the impacts on mortgage. And if you don't like to read, I'm happy to run through kind of a quick Cliff Notes version as well. And I'll let you guys correct me where I'm wrong or chime in. So real briefly, HUD, first off, including FHA and Ginnie Mae. So from the HUD's Office of Single Family Housing, they're going to continue to endorse new loans, except for HECMs, Title I loans, or loans requiring an FHA underwrite. Sorry. Lenders are still going to have access to HUD systems like FHA Connection, but actions requiring HUD response are going to be delayed and or suspended. Same for inquiries through FHA resource centers, and then FHA will continue to pay partial claims. Ginnie Mae, largely unimpacted due to its 2-year MBS guarantee commitment. The VA USDA, there's no public 23 contingency plan, but if they follow the 2021 shutdown playbook, loan guarantee programs would continue to operate at reduced capacity. USDA would be expected to cease operations with exceptions such as construction draws, processing guaranteed loan claims, as well as foreclosure sales support. On the rural housing front, USDA won't issue new rural housing direct loans or guarantee loans. Fannie Freddie, the federal home loan banks, largely unaffected through this. And then other key areas that do affect loan regular processing, tax transcripts. So during past shutdowns, you're all probably familiar, IRS shuts down or suspends issuance of tax transcripts. So from a Freddie standpoint, they require 506Ts signed, but those can be processed after the loan closes. Same boat with Fannie, unless the borrower income can be verified through DU. So in that case, no 4506T is required. And last piece here, my team had some great feedback. Shout out to Faith Howard Mooney, who's on here for the heads up, just through some of the working group calls. And I wanted to share that too. So just thinking out there, government employees that are being furloughed, obviously they're going to be impacted with their ability to verify income and employment with no incoming pay stubs or direct deposit verification. Social security number verification is likely to be halted as well. And if you're trying to process loans with self-employed borrowers and needing to provide tax transcripts, that's likely to be impacted as well. I'll breathe for a sec. Guys, I miss anything out there?
Thankfully, most companies only have about 8 or 10 loans in their pipeline. So hopefully the inconvenience isn't so bad. Was that gallows humor? Did I say something wrong?
I love when I go through the hard facts and you level set for where we're actually at right now. So
no, but
great,
I made the point, I made the point in my commentary today, what about Fat Bear Week and the national park cams? Are they going to be manned or not? That's the big question out there. But I also make the point as if lenders don't have enough to worry about. So I encourage people to look at my commentary today. I kind of spell out a lot of that, Tom, and I think you summed it up very, very well. It's as if we don't have enough to worry about right now. Now this. So
yeah, exactly. I'm to your point. I'm glad I don't have any trips planned to a national park or should be interesting too. We talked about just all the conference travel right now. TSA is still going to be working while not getting paid. Same thing with air traffic controllers. So, get to your airports early and don't be surprised if you see any delays in your upcoming travels. One more thing I want to touch on too, and shout out to our partners at Matic. They had a great article on this. I'm going to drop that in the chat as well. The National Flood Insurance Program. So it covers nearly 5 million properties. That also expires at midnight. So just quick cliff notes there. Existing policies remain in effect, will continue to do so until their expiration, but new policies cannot be issued until reauthorization of the program takes effect. So to Rob's point, you may only have 8 to 10 loans in your pipeline, but if you quantify that, estimates from NAR say, as many as 1,300 loans daily could be impacted. And if you aggregate that, that's about 40,000 loan transactions on a monthly basis that would be postponed. So, and then you've got existing policyholders, kind of left to hold the bag in the event of a flood or natural disaster. But Matic in their article too say from a lender standpoint, watch out for guidance from the FDIC or Federal Reserve. Rob, I'm glad this isn't St. Patty's Day off the drink for the reference of the Fed on guidance on how you should conduct business, without flood insurance, and educate your borrowers on their options. Also, a good heads up, lenders should consider referring their borrowers to private flood insurance carriers. While they can't write policies in high risk zones, FHA will still allow borrowers to obtain flood insurance on the private market. So a lot of good work.
Yeah, Audrey Boissonneau chiming in to say private insurance could be the way to go. And Tom, as I recall, you brought up the St. Patrick's Day
I got
rundown. I believe that was your first show. And
it was.
For people who hadn't tuned in, Tom threw down the gauntlet and said every time I could work FDIC or Federal Reserve into the discussion or bring it up, he would take a sip or a gulp. started off with gulps, and then I think by the end of the show it was sips. But it's amazing how much, information, how many times I could say FDIC or Federal Reserve, especially with, what's going on there. So Tom, you were a good sport.
I try to be, Rob, and yeah, appreciate you really leaning into that one. I think I had put down about 3 tall boys by the end of that episode, and yeah, had a friendly buzz to start my Friday off. But
Evan and Larry are saying, "Why are we on the show? What are we doing?"
right.
I mean, I
you
could
guys,
be.
you guys are the real eye candy for our audience today. But on that note, um, let's talk about something a little more engaging and opportunistic to our industry: special purpose credit programs. Laird, kind of the aforementioned expert here. Just to help level set for our audience, maybe you could bring just a brief overview for those less informed, exactly what a special purpose credit program is, and then we'll kind of do more of a deeper dive from there.
Okay. So a special purpose credit program, really is a lending program that allows for special financing or special changes, or basically different guidelines than would otherwise be allowable under ECOA. And really, they're not new. They've been in existence, I think, since 1974. But in the last 2 years, I think they've really kind of taken the part of the CFPB and the regulators came out with pretty strong statements in support of them. But they really are an excellent tool for really starting to work on issues of housing equity. And more and more lenders are doing it. I think that it's going to just increase in there's just going to be an increased interest in them. What I'm hoping, though, and I hope we talk about it today, is the importance of having special purpose credit programs that are different, so that we don't have hundreds of the same ones around, really causing what's supposed to be a unique set of guidelines to just become like sort of standardized, with still major holes being left in the whole system.
Let's go right to that, honestly. From your experience in seeing that, aspirationally hoping lenders will avoid kind of a cookie cutter approach to special purpose credit programs, what are some of the common gaps maybe that you see out there in your travels and lenders that you work with that don't get addressed?
So there are really 2 basic types of SPCPs, people and place-based. And initially, I was hoping that I would see an equal amount of each. And really, what people-based is race-based. It's basically saying that you make the choices you make, and the different regulations apply to people of a particular protected class. Place-based program doesn't necessarily look at the race, ethnicity, age, whatever the protected class is of the borrower, but is focused on the community. So, SPCPs that are place-based will have regulations based on either where the property is located, is it in an MMCT, or where potentially the potential borrower is actually living at the time of the application. There are reasons that both work well. But one of the biggest concerns, and I was on a Project Reach call yesterday, one of the biggest concerns is that with this overwhelming number that are really being place-based, the issue with that is when you have a place-based plan, there's a high likelihood or a higher likelihood that you're going to end up serving people other than your intended segment that you want to serve. So if someone lives in a majority minority census tract, they're eligible for the SPCP. There are a lot of, think about it, majority minority census tract, 51%, that other 49% would be eligible for it. So I think that's one of the major differences. The other thing that we're seeing is that, again, a high percentage are really being focused on documents. It is the easiest of the different programs to administer, to evaluate, but I don't see as many programs that are really focused on, expanding credit guidelines, working on the things that what I consider to be a little bit more complicated issues of, that are sort of the challenge for a lot of the borrowers. I am going to let Evan talk about their plan, though, because I will say that if I've seen a plan that does a really good job at being balanced and thorough, it's for First Commonwealth. They really have done it's a great plan. So I'm gonna let him talk about that because he was the creator.
Thanks, Laird. And yeah, I have to be fully transparent, folks. Laird and Bernard and the team at iEmergent really helped us craft the vision for what our plan could look like, helped us with the data analytics to support the need for the plan. So if you're not familiar with the iEmergent platform, you're thinking about an SPCP, it'd be a missed opportunity to not pull up with Laird and Bernard to just kind of understand what the Market Smart platform can do for you. Everything from creating SPCPs to serve as recruiting tools, to figuring out where new and emerging markets might exist for your business. And to Rob's point, when everybody's got 10 loans in their pipeline, there's lots of opportunity. I'm sorry, Tom, would you want to jump in there with?
I just said you're making Laird blush in the background with the plug.
Well, I mean, I got to offset the purple hair with the red face. Like you got to tie those two together, right? But yeah, I mean, I affectionately refer to our SPCP as the kitchen sink. We tackled both low to moderate income census tracts, as well as minority borrowers, African-American and Latino populations, most specifically in the geography that we launched our SPCP in. We took on lower credit score profiles. We took on higher debt to income ratios. We really threw in down payment assistance, rate concessions, the whole gamut. And so, when you're thinking about the SPCP, there's been a lot of hesitancy in the industry, and for good reason. There wasn't consistent guidance from the agencies. The CFPB was saying one thing, the DOJ was saying another thing. The FDIC, OCC, and FRB were relatively mute on the topic. And so about 2 years ago, to Laird's point, we got some good, strong, affirming interagency guidance on how this applies to ACOA. And yeah, SPCPs are nothing but alphabet soups for those of you who haven't picked up on the vibe yet, right? We're just acronym after acronym. But I think the exciting part of it is we have very clear guidance that helps protect you as the lender. Should you adhere to plans, should you follow the process that's outlined in that supervisory guidance, you too can offer an SPCP that will both help reach underserved communities and markets, as well as to build your loan pipeline. And who doesn't want to build their loan pipeline today?
Now, Evan, I'm curious, you threw out a lot of different components that the bank looked to factor into your SPCP. Did you find in that experience and rollout that there were certain things that maybe didn't quite connect with the community or had to scale back at all at any point?
So we didn't have to scale back, Tom. And folks, I should just share, hey, look at that. We have our guest visitor.
Yes.
The youngest listener of the rundown here. That's right.
So Cosette may have been on like in the first week or two of life. And so if anybody hasn't seen a 3-month-old, or almost 3.5-3-month-old baby, there she is. Remember the dancing baby videos? With
more hair than I've got rolling. I'm jealous.
Yeah, let's not go there, Tom. Anyway, Evan, I'm sorry to interrupt, but you have to seize these moments when you can. All right.
No apologies needed, Rob. And I might go grab the 1-year-old who's still got some pretty chunky thighs and bring him into the equation should time permit. But, Tom, I think that we didn't really have to pull back on anything, but I was surprised. Debt to income ratio really mattered far more than credit score. Really surprising to me. I really thought, credit scores in the 620 to 600 range were going to be really a highlight of what made our program a success, and it was inconsequential for the most part. I think we had a few applications, but credit score wasn't a big differentiator. And the other piece to it was the down payment closing cost assistance and providing a lot of flexibility on how you can use those things there. So we partnered very closely with an MBA initiative called Convergence Columbus. I think they've now expanded that into Philadelphia as they're starting to kind of march on how they're going to attract more lenders to address the racial wealth gap. And we're kind of seeing similar trends out of some other lenders who are starting to come to market with SPCPs, that they're trying to be very thoughtful about what's needed. And I think it's really access to assets and access to credit. Those are the two big obstacles, and thus the whole need for credit, right? The whole SPCP credit is the central theme that you've got to weigh in this equation.
No, I love it. And Laird, I know you're directly involved with Convergence as well. And I want to say you'd posted something out, and I apologize, I don't have it prepared. Was there a launch of a new platform in Columbus this past week too? And if you want to give a quick plug on
Yes.
that.
Yeah, so it's called Bloom, and Bloom is sort of it's a website and information site really meant to engage potential home buyers into the process. I think it's going to be exciting. I think like anything else, as we use it and get feedback, we're going to think about different things that we can add. I am going to make a plug. I'm now involved with Convergence Philly as well, and I just encourage any lender that's in any of the 3 cities, Memphis, Columbus, or Philadelphia, to get involved, because it's a great place to hear about a lot of new ideas. But I did want to go back to one thing, when I started talking about, how I wish more lenders could do what First Commonwealth is doing. I think that one of the things that's a challenge, especially for the large lenders, is these kinds of programs, the more complex they are, the more difficult they are to administer and track and handle. And I think, one of the things that's so specific to the idea of the written plan and doing your, assessment of need and designing the plan is that it's very much market specific. But if you think about that, a lot of the Fannie and Freddie pilots, the lenders are doing something, they look very similar, but they're trying to do a similar thing across 9 or 10 really, really different markets. And that in itself poses a problem. So, I guess the question, I have is, let's say, take a large lender. Does it make more sense for the lender to do something more generic and cover more markets? Or does it make more sense for lenders to kind of share, pick and choose, work together, and each one picks the market where they have the biggest impact, so that it can be sort of a shared industry goal, as opposed to, all of us kind of dealing and working on the problem in our own lanes, and that's where I think Convergence is interesting, because I think it's a great opportunity to look at what solutions look like when they're sort of shared solutions. And I think that's, what's critical, and what's missing, in my opinion, right now, is that we're not, as an industry, coordinating the way that special purpose credit programs are designed and built and administered.
Well, and great points. I can imagine too, you're not going to have the same kind of components or attributes to a program in, let's say, Ames, Iowa, as you might in Marin County, California. Just because of the disparity in home values, or what it takes from an asset or down payment standpoint to procure that financing. A question for you both, just to close the loop on this conversation. Evan, from your standpoint, what did you leverage at First Commonwealth to measure success for your special purpose credit program? And then on the back end of that, Laird, I'd love from your experience, maybe any tips for the audience, for our lenders, if they're looking to deploy an SPCP, what they may want to leverage for measuring success.
You go first, Evan.
Sure, I'll take a stab at it. And, folks, we launched our SPCP in February, right? It's September. So I very much would characterize it that we are in the throes of it, right? And we are figuring it out as we go. But I think, there are like 3 North Stars that I operate under, all kind of pointing to the same direction. The first is, are we generating activity, right? Are we seeing applications? If you are seeing a massive influx, that tells you you're reaching the market that you're trying to serve. I think the second piece is understanding your performance to where the market's at, right? If everybody's cultivating the same generation of volume, that tells you you might not necessarily be unique. But I think kind of the third and most poignant piece is, are we really helping people? At the end of the day, I think mortgage takes a bad rap sometimes as being a transactional business. It's not. It's about relationships. It's about building generational wealth. It's about helping families move up the economic ladder. And I think just looking at our approval rate, our pull-through rate, whatever acronym or short term you want to use for it, when you're in the 80s and the 90s, you're taking appropriate credit risk, but you're also helping people. And so I think, Tom, probably a year from now will have a lot better intel and insight that I could share. But those are kind of our current focal points as we look at how we're evaluating success on our SPCP.
Well, that's to save the date then. We're bringing you back in September of 24 to see where you're at.
I like it. I like it.
There.
I think, in terms of what's important, I think one of the things that, I can't emphasize enough, and it's something when I was talking to Stan Evan at where were we just in Nashville? What we've seen that's very consistent though, and this is a plug for how this isn't just about equity, it's about growth. Every lender that's done that I know that has put together, a well-designed SPCP is seeing not just an uptick because of the SPCP, but an uptick all around. Because what the SPCP does is it gives the lender an opportunity to reach out to new borrowers and to indicate that they care and they're thinking and they're doing what they can to make the home buying process more accessible and easier. So across the board, we've seen that, sometimes someone will call because of an SPCP and they end up being, eligible for a normal, like a regular product. But it's the point of connection that's so important. And so what I think what to keep in mind about what's important is there's this written plan, and the whole point of the written plan is to encourage lenders to make sure that they're thinking about the market and they're making choices and designing interventions that are data driven. The same thing goes on the side of, how do you track that? I think it's just going back to that same thing. It's like, what are you looking at? You have to make sure that you are doing what your plan says you're going to do. You have to make sure that there are not any unintended consequences like disparate impact. And then you also have to, and this is where you can't really see it right off the bat, is how are the loans performing? What is it going to look like over time? And that's one of the reasons that the written plan requires, I think it's like anywhere from 6 to 18 months of reevaluation, because they don't want you to just kind of put it out there, keep doing the same thing if it's not working or if it's causing unintended consequences. But where I see that most lenders are, I don't know, I want to say falling short, but I think the thing to keep in mind is that SPCP is like any other strategy. You have to not just think about the plan and the design, but you have to think about how you're going to execute and evaluate it. And that's the piece that is the most complicated, I think, because you can have a great plan, but if you don't have the right loan officers, you don't have the right operations, you don't have the right outreach strategies, that great plan just sits on a shelf. And so I think that's where we're going to see the difference between them working or not. And I think they're going to be like any strategic program. If it's well designed and it's engaging and it's tracked, it's going to be successful.
I have a question. When companies bring this program on, is it usually from a grassroots effort from loan officers saying we need this, or is it senior management saying we need this, or both, or either?
I think,
and I have a follow-up question.
Sure.
No, go ahead.
Most of the time, honestly, it's coming from the top down. Usually it's, I just had a very large lender last week really feel pressured that they have to do one. So I do think it's coming top down. From what we've seen in the field, the loan officers, a lot of times, and certainly you might have a different opinion, they need a lot more explanation about what it's really about. So I think it's coming from the top down, for better or worse.
Yeah,
All right.
I think like one thing to think about is when you're designing these plans, it's usually a strategic corporate decision, a business decision to do so. But I think the best plans are inspired and you get ideas on how to build them from your ground level folks, right? I mean, loan officers know what borrowers are facing far better than somebody who sits in a gold bubble palace. So sorry, Rob, I know you have a follow-up, but I wanted to just.
No, that's good. And from a vendor's perspective, from LOS or a hedging system, hedging company, you name it, credit reporting, whatever, servicing, do these loans, I mean, are they treated any differently from an LOS or hedging perspective at all? No, yes.
I don't think so. I mean, I think early on, there was a lot of, for IMBs, there was a lot of questions about what they were going to do with them. But I think Danny and Freddie are sort of clarifying those positions.
Okay.
Evan,
All
do you
right.
think
So from a vendor's perspective, they may not even know that alone is in this program? Okay.
Which
Nice.
Rob is an interesting issue because it's hard to track what you're not tracking. So it'd be kind of nice if there was a way to have that be wrapped in so that it would be easier to do the framework and the analysis.
Yeah, I spend my life not tracking things, so that would be hard to track.
Well, speaking of what you spend your time doing, obviously putting some time in with the family this weekend. But I saw the salacious article, so I've got to ask Rob, when are you going to Fort Lauderdale to set up your new East Coast empire? I'm assuming you were the acquirer of the cross country CEO $30 million pad and waterfront Fort Lauderdale.
Tom, I didn't want to let that out. You're embarrassing me.
Guys, I'm going to put the address in the chat so that you can go pay Rob a visit.
Yeah, pool party.
Crispin commentary is paying off after all these years.
Tom, I send out a free, humble commentary. It's not, it's not a huge,
No,
not a
get
big
out of
deal.
here. You've kept
Anyway, let's not
a
go
whole
there.
generation of mortgage bankers informed over the years, and it's greatly appreciated. And great comment in the chat too from Howard, just that tracking is going to be key to disputing naysayers down the road who may look to blame SPCPs for increasing delinquencies. And I think that's relevant to lenders right now as they're seeing a lot of buyback inquiries come back on loans originated during the early portion of the pandemic.
And I think that's the whole reason for why the CFPB and the regulators want you to do the written plan. They want to make sure that you're required to do that tracking, even though technically you don't by law have to. A best practice like that is meant to do exactly what Howard's mentioning.
Yeah. So I joked about Rob's weekend plans as we wrap, but Evan, Laird, what's on the docket for you guys this weekend?
Well, one is 11 markets for an SPCP analysis for one. The other one is, as always, horses. Because every weekend is full of horses at our house. So
Laird, where are you?
we're in Des Moines, Iowa.
Not exactly horse country though, is it?
No, it isn't. It isn't. I'm from Maryland originally, but we have a nice. We don't have our own farm, but my daughter and I ride at a local farm. I grew up on a farm, so it's different to not have to do all the work. But as Bernard would tell you, it's our other home.
It's love and passion. Evan, what about you this weekend?
It's a pretty low-key weekend here at the Ziv Rinks in Pittsburgh, Pennsylvania, teaching the 4-year-old how to ride his bike, and trying to keep the 1-year-old who's now doing the pull to stand, walking, using anything he can get his hands on from falling and bumping into something. So sheer pandemonium. I wish I was messing with horses because 2 young boys.
Well, Godspeed with that. I'm still trying to get my 7-year-old across the finish line with riding the bike with no training wheels. And Audrey, appreciate the good FYI in the chat that they in fact do allow horses in all 50 states.
I'm surprised. I'm surprised. Be careful out there, Laird, because hundreds of mortgage bankers are killed every month by horses. So be careful.
I'll be careful, very careful. And Evan, I need to. I just have this vision of you having 2 very spirited boys. I don't know why, but
they're loud, they're obnoxious, they're aggressive. I don't know where they get it from, Laird. It really blows my mind.
You're not aggressive. I'm not gonna say you're not obnoxious in your own way, but I'm just saying what Stan tells me. I'm just telling you what Stan tells me.
There's a secret, y'all. It's snacks. Snacks are what keep the Ziv Rink men at bay. And that's all I've got.
I love it. Well, I'm going to wrap myself out since my Buckeyes are off this weekend. I'm going to be following the Kansas City Chiefs to see if, with the rest of the Swifties, if Taylor will make another appearance at local Cleveland or Travis Kelce's next game. We shall see about that. And if the relationship's real, I know that's really what you wanted to know about, Rob. But on that nice segue, close us out with your quality weekend plans.
Gonna play some hoops tomorrow and probably head out to West Marin tomorrow afternoon for a bit and go to the farmer's market with Marie and Cosette Sunday morning. Quiet weekend.
I love it. Well, everybody enjoy your time with your families this weekend. We never get enough of it. And Laird, Evan, thank you so much for joining us as always. And Rob, thanks for making me look good.
Anytime, every time.
I love you guys. Have a great weekend, everybody. We'll see you next Friday.
You too. Thanks a lot.